This is how close you are to changing your life forever. $10,000 and the Robinhood or Webull trading app. In today's video, we're going to talk about how money works. More importantly, how compounding money works. Now, if you saw that first clip and you thought to yourself, hey, I do have $10,000 and I also have the Robinhood and Webull app, this is what you can be expecting per month deploying the model that I'm going to explain throughout this video. $10,000 at the end of 1 year, you can turn into $19,786. At the end of 2 years, $41,000. At the end of 4 years, you will have turned that $10,000 into $166,000. It's not complicated. Anyone can do it. And you are taking advantage of simple human psychology. That's it. There's no funny games. There's no gimmick. You are just trading what other people also trade. Unfortunately, most of you have been tricked into believing that a Roth IRA or 401k is the best way to build wealth. At the end of 20 to 30 years, 40 years, if you make contributions every single month, you will retire with a comfortable $2 to $3 million nest egg. And there's possibly millions and millions of videos covering this. It's not worth it. Human psychology and purchases made are directly dependent on two emotions, fear and greed. In a fearful market or fearful state, you want to be selling that asset or ridding yourself of that entity as fast as possible, even if you take a loss. In a greedy market, you want to be buying that asset or getting that entity as fast as you can, even if it means you have to spend a little bit more money. At the end, you're still getting the same asset. One person paid $350,000, the other paid $500,000. It's the same property, same stock, same car. It's just derived on what market you purchased it in. Lucky enough for you, there is a free tool, CNN Business Fear Greed Index, that measures where the market is currently trading and what emotion is driving the market. Right now, the market is slightly greedy. It's 3 points above neutral, meaning that assets are being bought for a little tiny bit more than what they should be worth. In a fearful market, assets are sold for less than what they should be. Greedy market, assets are bought for more than they should be. We can correlate this directly to support and resistance. For example, on Tesla, the closer price trades to this green line, the more greedy the market is. The closer Tesla trades to this red line, the more scared the market is. We want to be buying our assets when others are fearful because they're going to sell them to us for less than that asset should be worth. We want to be selling our assets when the market is greedy because others will be buying those assets for more than they should be worth. Now, you should know that the market ebbs and flows. The market's going to have high points, it's going to have low points. You can go to the timeline on the Fear Greed Index and you can view where the market traded for the past year and a half, and you can see that in April of this year, everyone was scared out of their mind. We had 96% of the market expecting more downside. Fast forward 2 months, July, we had 78% of the market expecting upside. That's how fast the market can flip on its own sentiment. And all it takes is a couple news points. What we're taking advantage of is selling options during these periods of doubt or greed. Going to TSLL, for example, and this is a leverage version of Tesla, we're going to draw in those same support resistance lines, just for an example. We're going to say that a greedy market is if Tesla trades over 2089, and a fearful market is if TSLL is trading below 16. This isn't exact support resistance. This is just for an example. If we see the share price, it's currently trading at 1880. If we see the share price of TSLL dip to 16, that's a $2 discount. That's how we should be viewing that drop. If we see the share price push up to 21, that's a $3 increase. That's not something that we really want to buy because you wouldn't go to the grocery store and buy a $20 ribeye for $30. It's not how it works. It doesn't make sense. We want to wait for that asset to pull back a little bit. We want to wait for the market to fall in a period of fear or doubt, and then we want to deploy our funds into buying that asset. fast forwarded 2 months, just like we did from April to June, July, and the market is now expecting nothing but upside. We have 78% expecting upside. That's 78% of people that would want to purchase our asset that we bought when the market was in a fearful state for more than what we bought it for. Selling options is taking advantage of the weekly swing in up or down movement based on news events that come out every single day in the market. Data points like CPI, PPI, FOMC, those come out once a month. Most of them, if you look at on a weekly basis, you at least have one significant data point per week. People want to pay a premium on options, so they have the right to buy or sell that position for what they want. For calls, people will buy calls for the right to buy shares at that share price, even if the shares have appreciated. For example, if TSL is trading at $18.80 and I buy a $18 call, that means I have the right to buy 100 shares at $18 a piece, even though it's trading at $18.80. If I buy a put, that gives me the right to sell those shares. So if Tesla's trading at $18.80 and I go and buy a $20 put, it gives me the right to sell those 100 shares at $20, even though it's trading at $18.80. People pay a premium for that right, takes away the fear and greed from their purchases. For that peace of mind, they give us more money. We are selling options to them. In most cases, those options don't ever get assigned. They don't get purchased. They don't get exercised. We just pocket that premium for giving them peace of mind. That's what it's simply broken down to. In the bigger picture of things, looking at a 24-hour chart, this is the day-to-day move of the NASDAQ, something that you have been told since you were in high school to buy and hold for the rest of your life. By the time you get to 60, 65, you'll have a comfortable 2 to 3 million. In the bigger picture, it seems to just move up, doesn't it? If we go back to a 1 week time frame, zoom way out, looking at price all the way from COVID. COVID was the most fearful the market's been for the past decade. We dropped over 30%, almost 40% within 2 weeks, and then the market recovered. The market is designed to appreciate over time, and that is why you're told to just dump your money in a Roth 401k and let it appreciate year over year. It's going to have upside, it's going to have downside, but you can capitalize on those week-to-week moves or even the day-to-day moves, even the month-to-month moves. You can capitalize on those moves up and down, selling options to individuals that want to pay a premium for peace of mind, and you're going to drastically outperform what you've been told is a year-to-year gain. You can do month-to-month. Going back to the compounding spreadsheet, if you start right now with $10,000, and there's a playlist that I'm going to put this in so you can go and view other videos I posted regarding selling options. You start today with $10,000. This time next September, you should have $19,000. Now, $9,000 over the course of a year doesn't seem like very much to start, but then that $19,000 2 Septembers from now should turn into $41,000. Another 2 years after that, you should have $166,000 in your portfolio, and then you can see how big the numbers start to get. And this is on a year basis. This is not something that you're going to envision 60 years from now, 40 years from now. Not something you're going to have when you're 75 and too tired to go and do anything. This is money that you could build day to day. And the best part about it is, as you can see from the spreadsheet, it's percentage based. It's not based on how much capital you have. The percent gain remains constant. You just sell more contracts. By selling more contracts, you compensate for having more capital within the portfolio. So a $10,000 portfolio will open one contract, a $20,000 portfolio will open two. The percent gain remains the same. After about 5, 6, 7 years of doing this, your $10,000 start that you can start with today will turn into over $600,000. The more you contribute, the faster you build that snowball. You might not have to wait those first 2 years to build $10,000 into $40,000. You can jump right to $40,000 And in 2 years, you'll turn that 40,000 to 160, or you can jump right to 100. 2 years, you'll turn that 100,000 to 400,000. This is actual gains that you can make day to day. It's not reliant on what the market's doing. You're going to have upside, you're going to have downside. There's going to be periods where you're hot as hell. There's going to be periods where you might not be making as much money, but over the long run, the average gain, you can easily do 6.4% a month. For the past year, I've been doing 11.8 per month. That pretty much doubles what I'm anticipating for the year. So that $10,000 start at 11.8% a month after a year, it's now going to be 40,000. It's not going to be 19. Start today. Worry about it after. You don't need to wait until you're 60. You don't need to wait until you're 65 to be comfortable. You can start that process today. Again, I'm going to drop a playlist to this trading strategy. Go and check that out. That'll do it for today's video. Hope you guys enjoyed. Peace out.